your asset allocation that you want to talk about is your initial asset allocation. Let's say you choose 50-50 as an example. You are not going to hold 50-50 all your life. You're certainly not going to be holding 50-50 at the time of retirement. There's a big if. There are certain circumstances when you can hold 50-50, but typically speaking, I don't think you should plan for 50-50. So I would recommend after retirement, not more than 20 to 30% equity for most people, for normal people, because the YouTube viewers are always saying, commenters are always saying, I'm just an ordinary man. What about me? All this plan is not suitable for me. Let me give you a plan for the ordinary guy out there. 20 to 30% only, not much corpus to play with, not much of discretionary expense, whatever. So 20 to 30% equity is what I would suggest for the normal Joe out there. For those who have a lot more money, they can plan for more equity exposure. We'll come to that. But so your asset allocation is not a fixed thing. It's not going to be held in stone. You have to taper down your asset allocation gradually from, let's say, initially 50-50 or 60-40 equity to this 20-30% equity over time. So you have to change this. But what would be the starting point? How would you determine the starting point? There are two factors here. One is what equity and fixed income return assumptions are you going to make? The asset allocation depends heavily on that. Are you going to expect 15% from equity, which is immature, 12% from equity over the long term, quote unquote, or 10% equity before tax? I would say aim for as low a return as possible, because if you aim for the first floor, you will be happy if you get to the second floor.
True.
If you aim for the 40th floor, you're always going to be disappointed if you fall anything less. And you can't go back in time and invest more. So you aim for something like 10%. I would say youngsters should aim for 10% equity, not because that they're going to get only that much. I don't know what the future is. Nobody can tell you how much return equity markets will give you over the long term. There are some calculations like 4% GDP plus inflation, blah, blah. All those calculations are just nonsense. Equity markets does not listen to anybody. It doesn't follow any thumb rule. It just does what it wants. So you aim for the lowest possible that your investment will allow. Right, 10% before tax is what I would strongly recommend. Okay, if you expect only 10% before tax, the amount you should invest becomes higher. Therefore, okay, if it bothers you too much, make it 12% before tax. At best, don't go beyond 12% from your overall equity portfolio before tax. That's the first assumption you're making. And that's a big assumption. You don't know what the market's going to give you. So, second, how much is going to be your fixed income return? Assuming that you have only two asset class. Fixed income, I would say, aim for 7% if it's tax-free. We're talking about EPF returns, PPF returns after 20 years. We are not talking about current EPF returns, PPF.
Isn't 7% higher because we have seen gradual decrease in fixed income interest rates, and the cycle is going to.
I would appreciate you if you choose less, but I'm just trying to not dunk you underwater too much. Just saying, aim for something reasonable, because now it is already 7.5, 7.5, almost. EPF is 8%, 8-ish%, but expect at least 1% fall over the next 10, 20 years, maybe. But if you want to expect 6% from EPF and PPF, it's a solid plan, it's a robust plan. But without too much of discouragement, at least expect 7% and 6% from taxable fixed income, like debt funds.